Right now, BigBear.ai, ticker BBAI, is trading live at $6.06 per share. That's a significant drop intraday, down about 4.42% or 28 cents on heavy volume. And this is the exact tension point that confuses so many investors. The stock is falling today, yet it's only been 1 week since the company reported its third-quarter earnings, a report that on the surface looked like a solid win. They beat analyst expectations on earnings per share, posting a smaller loss than forecast, and they also beat revenue estimates. So why is the stock struggling? Why is it red on a day when many are looking for follow-through? This is the core of the BigBear.ai story, a powerful expectation of a disruptive, high-growth AI company running headfirst into a complex and often contradictory reality. The general belief, the narrative you'll see across social media and forums, is that BBAI is the next great pure play on artificial intelligence for national security. It's often called a mini Palantir, a smaller, more agile vessel that could capture enormous government contracts for data analytics in defense and intelligence. Investors see the AI megatrend and assume this company, with its deep government ties, is a ticket to massive gains. They saw the Q3 earnings beat and the simultaneous announcement of a major $250 million acquisition of a company called Ask Sage, and they expected the stock to truly break out. But the reality, the reason the stock is likely under pressure today, is what was buried beneath those headlines. That revenue beat of $33.1 million was still a 20% decline from the same period last year. The company's sales are shrinking, not growing. And that profit of $2.5 million, it wasn't from operations. It was, according to their own filings, driven almost entirely by non-cash changes in the value of derivative liabilities. Operationally, the company posted a negative adjusted EBITDA of $9.4 million. So you have a company that's part of the hottest sector on Earth, artificial intelligence, yet its revenue is falling and it's still burning cash. This is the disconnect that professional traders are focused on, and it's why the initial post-earnings pop has fizzled. This recent volatility tells the whole story. The stock did jump in after-hours trading when the news first hit, precisely because the headline numbers looked good. But as institutions and analysts dug into the 10Q filing over the following days, the enthusiasm cooled. The market is now digesting the fact that the company's full-year revenue guidance, projected between $125 million and $140 million, isn't the explosive growth people wanted. In fact, it continues a trend of the company struggling to meet its own targets. This isn't a new problem. They also missed their 2024 sales guidance. So the market is left with a difficult question. Is the new Ask Sage acquisition a brilliant move that will reverse this trend? Or is it a costly defensive maneuver by a company whose core business is struggling? This brings us to the short-selling activity, which is a critical piece of the puzzle for BBAI. Right now, the data shows that short interest is high, sitting at 18.32% of the public float. That means for every 5 shares available to trade, nearly 1 of them is a bet that the price will go down. Over 79 million shares are held short. This confirms that a significant portion of the market sides with the bear case, that the shrinking revenue and cash burn are fundamental flaws. But here is the actionable insight that most people miss. They see a high short interest and immediately think short squeeze. But you have to look deeper. The borrow fee rate, the cost to borrow BBAI shares to short them, is incredibly low, hovering around 0.55%. This isn't a crowded, expensive, or difficult to find short. It's cheap and easy. Furthermore, the days to cover is only 0.71. This metric tells you how many days it would take for all shorts to buy back their positions based on average volume. Anything under 1.0 is extremely low. It means shorts are in no danger. They could cover their entire positions in less than a single trading day if they wanted to. What this data implies is that there is no imminent squeeze. The shorts are not trapped. They are sitting comfortably in a low-cost, highly liquid trade, betting that the company's fundamental versus hype valuation will eventually correct. We also saw spikes in fails to deliver in September and October, which can sometimes point to market structure issues or naked short selling, but with a borrow rate this low, it's more likely just a symptom of high volume and volatility in a low-priced stock. For a retail investor, this means chasing a squeeze here is exceptionally risky. The data just doesn't support the thesis. What's your read on that low borrow fee? Does it mean the shorts are comfortable, or is the data lagging? Let me know. The smart move isn't to fight the shorts, but to understand their thesis. They are betting that the company's $376 million backlog isn't converting to revenue fast enough, and that its heavy reliance on a few government clients makes it a fragile business. On platforms like Reddit and X, you can see this battle playing out in real time. The bulls are focused entirely on the future. They see the Ask Sage acquisition, with its $25 million in projected recurring revenue, as the new growth engine. They talk about the company's Pro model and Vespido platforms as undiscovered gems for commercial clients. They are long-term believers in the national security mission. The bears, on the other hand, are pointing to the consistent insider selling from the CFO, the CEO, and the general counsel over the past few months. They're also watching the convertible debt notes that can be converted at $3.53 a share. They know there's a key price level around $4.62 that, if the stock holds above it, could allow the company to force conversion, which might create complex new share dynamics. So, what does BigBear.ai actually do? At its core, it's an AI and data analytics company. It builds predictive models and decision support tools. Its primary customer has always been the U.S. government, specifically the Department of Defense and the intelligence community. They help analyze battlefield data, optimize supply chains, and identify threats. This is without question a critical and growing field. The problem is not the mission, it's the business execution. This is especially true when you compare them to their main competitor, Palantir. In the same period that BBAI's revenue is shrinking, Palantir's U.S. government revenue is growing at over 40%. Palantir is successfully taking market share, while BBAI seems to be treading water, or worse, losing ground on its core Army programs. Looking forward, the entire story hinges on the Ask Sage acquisition. This is the company's big bet. The bull case is BBAI successfully integrates this new generative AI platform, which is already cleared for secure government work. They can then cross-sell it to their existing defense clients and use it to win new commercial contracts, finally reversing the revenue decline and creating a new, more profitable business line. If this happens, the stock is cheap, and the bears will be forced to cover. The $376 million backlog will finally start converting, and the company will begin to grow into its valuation. The risk, of course, is the bear case. The integration could be a failure. It could cost more than anticipated and distract management while the core business continues to decline. The revenue from Ask Sage might not be enough to offset the losses from the legacy contracts. In this scenario, the company will continue to burn cash, and with a recent $337 million stock offering, investors are rightly concerned that more dilution could be on the horizon to fund operations. The company is in a race against time. It must prove it can be a growth company, not just an AI-themed company. Comment below with your position. Are you holding BBAI for the long-term national security play, or do you think the revenue decline is a terminal problem? In the end, we are left with a perfect example of expectation versus reality. The expectation is a disruptive AI powerhouse, a small-cap rocket ship. The reality is a company with shrinking sales, accounting-driven profits, and a very comfortable, very large short-seller contingent that isn't paying much for its bet. The market's 4% drop today is a vote of skepticism. It's telling us that despite the headlines, the underlying engine is sputtering. The Ask Sage acquisition is a bold, necessary move, but it is a gamble. And until that gamble clearly pays off in the form of renewed top-line revenue growth, the market will likely continue to treat the stock with deep suspicion.